Implied open suggesting a positive start. Let's see if we build on from there.
Yeah, and the Nifty is down 700 points in the last 6 days. It's negative returns year to date. So, like Niraj said, the downside risk has opened up and there are no major upside triggers as we see it on the street. You've seen some play like tech and pharma doing okay, but that could largely be defensive play, not enough to keep the market afloat. And a little bit profit off the table is not a concern either for investors. Let's not forget the markets were well timed for either a price correction or a time correction. Either ways, it seems like it could be a long drawn price correction over the next couple of months in terms of trade. Well, the margin of safety also is much lower after the recent few years of rally that the markets have witnessed. GIFT Nifty indicating to flat to slightly higher start. This still doesn't mean that we will continue gaining through the day. It could be a morning of a slightly gap up open, which could see some profits getting off the table in the second half of trade. So I think lots of factors to watch. Lack of any major market movings apart from the RBI policy that may happen in a few weeks could give us some direction, but I don't think there could be too many concerns just that. But I think one thing, Niraj, which may turn out to be that negative trigger could really be crude. Crude at $87 a barrel is highly uncomfortable. I talked about this yesterday where we said OMCs could be under pressure because crude was about 85. This morning, crude is about $87 a barrel. So if it continues to inch higher, it's going to be a worry for our macros. It's going to be a concern for most of our sectors. OMCs will, of course, lead the way down. And at 87, I don't think even India is comfortable at those levels. So if there've got to be any sort of negative triggers, I think this one would lead the way.
We have seen crude up to 90, and that's where things start getting sticky. But you're right, the upward trajectory will be something, not yet the panic button, but the direction.
Getting in the panic.
The direction is an issue. It's also interesting how the whole narrative has changed from too much supply to too less supply, and how it's also come from two major producing nations who are trying to tighten the screws there. So crude is one. Just a few other stocks to talk about.
We'll move on. You guys were talking about TCS yesterday, yesterday, of course, of the block deal. This morning, again, TCS in the news. A regional bank in the US has actually signed a big order with TCS to use banks, their universal financial solution, to update its core technology. We don't know the size of the order yet, but I would imagine this one is significant. Could see a positive reaction, at least sentimentally, after that fall in trade yesterday. Niraj, of course, will dwell on whether or not these are sustainable order wins coming from the IT pack. But for now, it's a one-off. TCS looking, we will see a little bit of an uptick in early trade. Well, you've also got Aurobindo Pharma. They've received a final approval for a nasal spray. This one was in the works for the last couple of months now in terms of the US FDA approvals. The approval has finally come through. Big positive again on Aurobindo Pharma this morning. A positive up move could be expected in the early minutes of trade. From the broader markets, it's Shakti Pumps that has been very active in terms of activity from buyers. A lot of institutions, a lot of big private buyers have actually picked up stake in Shakti Pumps. We've heard this morning that the board has approved a QIP of 200 crores at a floor price of 1272, which is pretty much at the close of yesterday's price. So again, this one could be in focus. Shakti Pumps has kept a lot of the broader market participants fairly active.
So some of the stocks that I was looking at, and one piece of news that caught my eye was Zomato. Zomato's been in the news for a variety of reasons. There's a Jefferies, in Jefferies' top list of companies that they like Zomato. They've had problems with the GST, demand from Gujarat as well. But this announcement from Deepinder Goyal, so conversations with any analysts or journalists, they don't really do that. They just announce everything on Twitter. So they put out a picture and saying that they have a separate fleet for pure vegetarian food orders. So they've launched a pure veg fleet, which will only serve orders from veg restaurants. And they will also roll out a special cake delivery fleet with hydraulic balancers in a phased manner. And they will be adding more specialized fleets for special customer needs. Now, I don't know how revenue accretive this is going to be, frankly, because you have a huge bulk relatively of vegetarian people who may want to order, but as a portion of the population, you have more non-vegetarians. And I don't know if this was a negative for people to order from Zomato before. So it seems like a bit of a maybe a marketing thing, and that's fine. If you want to cater to various customer needs, that's great.
I really want to know what Niraj has to say on this one.
Because I'm a pure vegetarian, right?
No, that's okay. My question is, what is a pure veg fleet? The food is
They'll wear green T-shirts.
Is that it, or do they have to be vegetarians as well?
No, so again, I concur that it's a great marketing tactic. Why do I say this also? Because we've seen, for a select band of people who are vegetarian, and I confess that I'm in that bracket of being vegetarian, but there are peers of mine who, for religious reasons, do not go to a restaurant which serves both vegetarian and non-vegetarian. They are of that nature, and there is a band of people who do that. Now, Dipinder Goyal has said that they are launching this. Doesn't mean that the size will be equal to the normal fleet. It could be a small subset, but it might invite people who hitherto were shying away from ordering on Zomato to order on Zomato. So think of it as a business decision.
Veg filter when you order.
No, but the ordering is... So maybe people, I don't know, maybe they got feedback from people that why don't you do this, and that's why they've done this. Who knows, right?
I'm going to compare this to something that the financial sector does, right? Every Women's Day, you'll have a launch of women-only financial products, right? Again, this is a great marketing gimmick because financial products, men can also use...
But that's different, right?
We all want to create wealth.
On food, it's different, right?
It's marketing because you could pick a pure veg
financial products are ubiquitous.
The app is...
okay, we can go on with this. Let's do this another time.
This is why it's an interesting story. And I just want to say that if you are catering to a certain customer, target audience, that's always great because the more you specialize, the better it is. But
Tamanna, you're smart. You invoke the mood of the nation in this debate.
Let me just
let the nation debate this.
Let me just wrap up because people have a choice what they want to order from. But there should be no sort of restriction on providing employment. That's why I'm a little worried about what that pure veg fleet means, because players like Zomato, etc., that whole gig worker industry has provided a lot of employment to people who may not have had other jobs. So there should be no sort of slicing and dicing there. Of course,
but let's
move on.
All right, next stock. Ultratech Cement is the other one. CCI has approved a scheme of arrangement. So basically an overhang which is now out of the way. So Ultratech and Kesoram is one that I would put on my sort of list. They've approved a scheme of arrangement with Kesoram Industries for the acquisition of the cement business. This has been going on since November 23. So that's one that I would watch on. JP Morgan on Tata Tech was the other one, and this is something I think Niraj also flagged off this morning. It's initiated an underperform with a target price of 800. So they say while ER&D remains a star sector, and that was the big selling point. Remember, this was, I think, one of the most successful IPOs ever in terms of subscription numbers and the way it opened. They say company has high client concentration with limited evidence in scaling non-anchor clients. And this was always an issue from day one as far as Tata Tech was concerned, that their biggest client, I think, has about 60-70% of revenue share. So that's one that I would watch. There are more, but I'll come back for round two.
Yeah, so underweight on Tata Tech, yes, and overweight on Cyient with a price target of 2,600. So that's interesting from the JP Morgan note. Now, three stocks from my end. Firstly, Siemens. Siemens Global yesterday warned of persistent China, of pressures because of persistent China slowdown weighing in on orders. And they say that the China stimulus that is coming out is not really helping immediate order flows. Now, this is for the global business, not for the India business. The India business has some other tailwinds as well. But because the stock, Siemens, globally fell significantly in trade yesterday, and Indian business also took a bit of a hit yesterday, by the way, 4% down. Let's see if there is more in store. So be mindful of this particular piece as well when it comes to Siemens. So that's to certainly be watched out for. The CFO, I think the finance chief, Ralph Thomas, commented on the revenues in the flagship deal. They spoke about how 10% revenue drawdown, etc. So watch out for Siemens in the session today. Speaking of brokerages, watch out for Sirma. Now, Jefferies has come out with a note on the EMS stocks. Now, amongst everything that they've done, rated, I've chosen Sirma in particular. They have a buy out there with a target price of 640. Now, Sirma is at 474. So that's about a 28% odd uptick, or maybe more than that actually, or circa that level, kind of an uptick. They say it's a favorable risk reward because it's a well-diversified company into various verticals. They believe that incremental focus on niche verticals can drive a PAT CAGR of 57% from FY24 to 26 and drive ROC uptick to 21% by FY26, doubling of ROCE as well. And they're assigning relative to the sector, a modest PE multiple of 38 times. So do watch out for this one as well in the session. Let's see if Cinema reacts a bit. And LT Foods could be interesting. I think Samina probably spoke about it. Abacus has bought about 34 lakh shares, just about 1%, at a price target of at a price of 162. The stock was down yesterday. Let's see if there's a bit of an uptick in the session today. By the way, just speaking of LT Foods, yesterday was down 4%, but the delivery volumes marked were about 10 times the 1 month average. So naturally, because of Abacus buying and otherwise, this would have done well. This is the kind of delivery. It'll be interesting to see if LT Foods and some of the others out there marked in the price volume delivery patterns could react. But LT Foods in particular, because Abacus has bought into it, usually that name evokes a response. Anything else, guys?
A couple of notes just quickly before we go to editor's cut. RR Kabul, Citi has initiated coverage with a buy, target price of 728. I found that interesting. Despite lower than industry margins, the pre-tax ROC is what they like at 18%, and they see a margin improvement. Nuvama on Dabur, and of course a lot of those details are on your screen as well, but just to quickly take you through them. Buy with a target price of 680. I found this interesting because all of that pack, the FMCG pack, has been really, on the fringes of everything you're seeing in the market right now. But their focus on premiumization and scaling up existing categories to new agencies caught my eye as far as the Dabur is concerned. And Bernstein on Bajaj Auto. Bajaj Auto has been having a great run, I think, the last couple of weeks. So they've rated it to an outperform with a revised target price of 9,400 for increased near-term and long-term estimates. Yeah. So those were a few. Yeah.
Okay, well, that's the long and short of the trade setup and all the stocks that you need to monitor around the session today. But as Tamanna and Samina have stated, we're going to be talking about IT a little bit. And Alex, while I'm the one coming for it, I'd love for you to tell me what I'm talking about.
Niraj, are you absolutely sure you want to talk about IT? Because of the conversation that you had earlier this morning, just a few minutes back, about Zomato's decision to have a separate feed sounded fascinating.
We'll do the whole show and still not arrive at a conclusion for that.
Okay, so let's try and get a conclusion on this conversation, which is that you saw TCS drop in trade yesterday, dropped over 4%, not something that you see every day. And you also saw quite a momentous decision by the BOJ. Now, the question that we're asking is about the broader IT space, whether this pullback indicates anything or should require you to examine the bull run. Oh, wait, am I confused? Is it the bull run or the bear case? Which is it?
So you could argue a bit of both, Alex. Yeah. Why do I say this? Because while IT has been under a bit of a cloud and every attempted pullback has been sold into, maybe for the right reasons, it still trades at a premium to the Nifty. And every single, there is a Jeffries note that came in December, which spoke about how every single time that the Nifty IT is traded a premium of over 25%, 30% to the Nifty, it has underperformed in the subsequent 12 months or thereabouts, something like that. Now, here's the case. I mean, the key points. So, if there are potential delays in the US rate cut cycle, something that we spoke about in the trade setup again today, right? That impacts the re-rating of the valuations. People have been betting on rate cuts coming in, IT pack across the world moving up, IT services in India moving up. That gets delayed, the valuation re-rating, if there are potential.
Assuming, to make that a complete conversation, assuming that somebody has not heard that piece, what was said in the trade setup on rate cuts?
No, just so we were arguing about whether the chance of a rate cut comment from the Fed
today
gets nullified.
Right.
Simply because there might be a year, 2024 might well turn out to be a year of no rate cuts as well. People are talking about that. So, therefore, if rate cuts are delayed or postponed for 2024, that makes the case of valuation re-rating for IT across the world and IT services in India a bit futile. Emphasis CFO, and we highlighted this yesterday in a conference to Citi or otherwise, but to Citigroup mentioned that there is no change in the demand environment since the start of the quarter. So, however, when we talk about idiosyncratic wins for companies, there's no change in the broader demand environment.
Like the TCS win.
Like the TCS win today, but that's very, very specific. Otherwise, there's no change out there. There is lack of clarity about Indian IT companies' ability to mine the AI opportunity. And one of my fellow co-anchors has been very anal about it, that where is it that the AI is happening? Read Tamanna. Lastly, valuations are still trading at a premium. And I'll get into the valuation argument, but valuations are still trading at a premium to historical averages as well. I'll get into that as well. The other piece is, currency moves, Alex, the argument is, can currency moves and the typical 4% average CAGR INR depreciation, is that questionable for the rest of the decade? And nobody has the answer to this, but I'm just making a point out here. 2 points. The BOJ policy normalization, while thus far, as Samina said, hasn't had the resultant impact on the yen-dollar equation thus far, right? In fact, the yen did weaken as opposed to strengthen.
Yes.
But could it strengthen over the case? And could the dollar largely weaken? And if indeed the dollar were to weaken against a basket of currencies, including INR, and again I repeat, there is no way to predict this because it's very difficult. Most people fail.
Yeah.
But if an assumption is made that because of India's current account deficit being a lot better than the past, and if indeed some moves like this weaken the dollar in general against a basket of currencies, and therefore, if the INR depreciation is not 4% but 2%, that's a quote-unquote net negative for IT services as well.
Perhaps it's a separate conversation, but I would argue that it is contingent on the rate decision and the rate move by the Fed, because in a situation where the Bank of Japan has raised interest rates, you still have the 10-year Treasury trading at 4.3%. So the gap between the yields in Japan and in the US are not small.
But even if that is an imponderable on the global
Sure.
basket, the Indian CAD numbers are here to be seen, and if those are narrowed, then likely that the pace of depreciation might be slower.
So what's the conclusion of this conversation?
No, there is no conclusion. I just stop. Okay, here's the deal.
Sure.
Just the valuation, and then I'll come to the conclusion. The valuations piece, right? Nifty IT is trading at a 25% premium to the Nifty 5-year to the Nifty versus a 5-year average premium of 18%.
Okay.
So Nifty is still at a premium versus the Nifty. Valuation wise, okay, one. Valuations are still above the 10-year average levels for most companies. Most companies, the 10-year averages are way lower than what the current valuations are, despite the fact that the sector has virtually gone nowhere.
Yes.
Part 2 of my question. Forget ER&D, that's separate, but otherwise, IT services, they are trading at a premium. And the mid-sized IT firms are trading at a 20% premium over the large-sized IT firms. So where the order flows are coming in thick and fast, the stocks are already trading at a premium. How do you account for more premium there?
So that's a strong argument against.
That's an argument too, right? And the only things that I thought could thwart this bearish case for IT, and Vikas Khemani was making this point, Pankaj Murarka was making this point, that they are constructive on IT because a stronger US economy may prompt companies to start spending on tech. Now, if they do, when they do, we'll know in the order flow.
Because they can't differ as they have for very long.
This is critical spend. But I mean, we'll know when they do it. So why try to preempt when they do it? Let them do it. You buy it 10% higher, but at least you're buying an uptrend as opposed to trying to, think of what will happen and buy it. And, the defensive bent of the market, if the market were to correct at large and mass, then IT is a safe haven, quality companies, cash flow companies, dividend paying companies, lower equity companies. Every year they do a buyback. You might want to hide in those. So that might thwart the bearish case, but otherwise, there's certainly no bull case to be made.
All right, and there you have it. So I don't think a lot of people have paid attention to the valuation premium to the Nifty 50. So maybe that, despite the fact that you have a bit of a crack in TCS yesterday, right? So that's something to consider. And I think Niraj's point is well made. But what do you think about it? Are you buying IT companies? And would you buy at this level with TCS down over 4%? Let us know in the comment section. And do stay tuned. Lots more coming up after this very quick break.
Welcome back. You're watching India Market Open. A quick check on implied Nifty. It was a positive close for Wall Street, and it seems like it could be a positive start for us too. But not to say that you wouldn't see any selling pressure in the second half of trade. Agam is standing by with all the F&O action. Agam, we broke 21,900 yesterday, down 700 points on the Nifty in the last 6 days, negative year to date. It's not looking too great. Even if we do see a little bit of a gap up, good chance that might get sold into.
Very possibly so, because once you lose out on 22,000, there's always a little bit of pressure considering you lost out on that psychological round figure when it comes to the Nifty. Talking about that, it was largely a handful of names, heavyweight names such as TCS, which actually weighed on the Nifty yesterday, which is why you saw the drop around 1%. And, this is something which was not surprising at all. Very little change in open interest. It's been a trend through the March series. The Bank Nifty, the picture isn't very different. We saw the index come off by around 0.4% with very little change in open interest. It is the options market where things have changed slightly, obviously because the Nifty has moved below the mark of 22,000. So naturally, we also start seeing a lot of writing in calls in terms of around 21,900 and 22,000. So a lot of strikes below 22,000 are now once again active in terms of calls. Of course, as far as puts are concerned, and that should be a little bit more evident in your overall open interest picture. So let's pull that up. And that's where you see about 22,000 as the one with the most amount of accumulation in calls. But in terms of puts, there has hardly been any accumulation whatsoever. So at the moment, it does seem like traders are still making up their mind as to where they want the support to be. Or rather, what puts do they want to go ahead and sell in anticipation of perhaps a little bit more weakness coming in. And of course, it is also the Bank Nifty expiry today. 46,500 seems to be that kind of a level, in and around which you tend to see the Bank Nifty move. Can we call that a pivot? I'm not sure about that, but we certainly do see a lot of moves hanging around there. Consolidation continues to take place around there. And of course, in terms of stocks, now we saw a lot of weakness in the broader markets, and we saw, in fact, shorts in TCS, Indus Tower, Asian Paints, Gujarat Gas, and along with Oracle Financial Services. And among stocks which saw unwinding in trade, longs unwinding for Aurobindo Pharma, Tata Steel and Tata Power, Balrampur and Chini and Bajaj Finance among the two counters which saw a little bit of buying. So that was, of course, short covering coming through. The question is, what do you do in these markets, and what are the other stock ideas that you can build on? Well, let's find out from an expert here. We have Aditya Arora of Analytic Research, who's joining us on the show. Aditya, good morning. Thank you so much for joining in. Your view on the Nifty and the Bank Nifty, how do you go about them?
Very good morning. I think markets are, trying to consolidate with downward bias. But my focus is more on Bank Nifty, which is catching my eye because if you look at heavyweights and index component like HDFC Bank, then they are consolidating since last many days. And if you look at ICICI Bank, it's doing pretty good. It was up yesterday a little bit, and prior to that, it was also consolidating. And Axis Bank also rebounded quite sharply 1 day back. So I think all the heavyweights are doing pretty well. It's just SBI which is creating the pressure for Bank Nifty since last 5 to 7 days. But other stocks are doing pretty well, and the patterns are very impressive. And one more thing to note is that there was a short unwinding in HDFC Bank. So after the fall, there was significant short buildup, but that has been, squared off right now. So that is very positive sign for Bank Nifty. I think a lot of accumulation is also seen with good volumes in HDFC Bank, and even Kotak Bank saw similar kind of long buildup since last few days. So I think all the components of Bank Nifty are poised pretty well. They are forming bullish pattern. Data is positive. You can see accumulation. Technical patterns are good. I think market is just waiting for one good trigger. Then private banking space could just take Bank Nifty to the sky. And I think a rally of 1 to 2,000 points wouldn't be surprising because if HDFC Bank, shoots up and all the heavyweights shoots up, I think it's very easy task for Bank Nifty to go up. So my bias is pretty bullish on Bank Nifty, and I think Nifty may catch up soon, but I'm very bullish on Bank Nifty from here, and short from here is not very good from risk to reward point of view.
Fair enough. So positive on the Bank Nifty at the moment. But Aditya, I believe you have two ideas in the IT space. Can you take us through that?
Correct. We saw good correction in IT space yesterday, but now IT stocks are trading at support levels and the sentiments from the global market are pretty positive. So my bias is positive in this space. The two stocks which I've selected are TCS. So in TCS, 3900 put option can be sold at 33.10 rupees. 33.10 and stop loss should be 65 and target would be 0. So bias over here is bullish. The second one is HCL Tech. Over here we can sell 1550 put option at 10.65. 20 is the stop loss and 0 is target. So bias over here is also neutral to bullish.
Okay, so Aditya is actually recommending selling two put options, and of course this is without any hedges. Aditya, just a follow-up question here. I reckon that what you're providing here is for the March series. Now, if you were to play a similar structure for the April series, but perhaps also provide a hedge, what kind of cover strikes would you apply for both TCS and HCL Technologies under these circumstances?
True. So if we had to do similar strategy in April contract, then 3900 put option must be sold and 3800 put option must be bought. So this would be a credit spread, and here again the bias would be bullish. And same for HCL Tech in April contract. If we sell 1550 put option, we'll buy 1500 put option as hedge. But bias over here again would be bullish, and it would be a credit spread.
Aditya, thank you so much for joining us and taking us through your views and also providing us with some alternative strategies when it comes to the two names that you have spoken to us about. And with that, it's back to you, Niraj.
Hey. Thanks for that, Agam. So this will be interesting to see what kind of day do we have today, because we'll start off well. The implied open should come up on your screen and you will see a start which is looking slightly positive. The only question is, can we build on from there? So you've already gotten a view on the Nifty and the Bank Nifty, but I'll get in Aditya Agarwala, who's Head of Research and Investments and Invest for EDU, for one more perspective out there. Aditya, thanks for joining in. Quick thoughts, do you have a trade, Aditya, on the Nifty or the Nifty Bank today? Can somebody trade the Nifty today?
Morning, Niraj. Thanks for the show. More than Nifty, I would say Nifty Bank is something which stood tall in trade yesterday, despite all the mayhem that we witnessed in the Nifty. Nifty Bank is something, if markets do open positively and sustains after that gap up open, I believe Bank Nifty is something which can be traded. 46,500 is, I'm eyeing something closely on the Bank Nifty. Is that were taken out and the Bank Nifty sustains above 46,500, I believe there's a case for a short covering rally in the Bank Nifty. And the heavyweights yesterday actually didn't fall much with the likes of HDFC Bank, ICICI, they stood in trade yesterday. So my sense is the large cap private sector banks are going to lend some kind of a support to the Bank Nifty, and we could see a pullback rally in the Bank Nifty. And if that happens, maybe there's a case for support in the Nifty as well, closer to about 21,800 is an immediate support. If that holds, maybe we can be in for a short covering rally till levels of 22,000 on the Nifty as well. But if I have to play an index, it will be the Bank Nifty rather than the Nifty.
Right. Aditya, any specific banks you would consider a long trade on, or even a short trade on, actually?
Morning, Samina. So it has to be one bank or a couple of banks are looking weak, definitely. But apart from that, HDFC Bank is something which is looking interesting, I believe. After a lot of correction, stock has entered into a consolidation phase now, and it's not showing any signs of weakness in all the market correction that we're witnessing. So maybe this is one stock which one should be on traders' radar and maybe added at current levels. can see a good 3 to 4% upside, closer to about 1550, 1600 on the upside is what I'm eyeing on the HDFC Bank. On the downside, immediate support is closer to about 1400 to about 1390, 80 as well. Second bank which is looking interesting is ICICI Bank. That too is holding its ground and looking interesting at current levels. Can easily test levels of 1150 on the upside with a good support at 1060 on the downside.
Stay on with us, Aditya. Meanwhile, let's put the focus on a key story also, and you may see a reaction in LIC as a result. So, market regulator SEBI has yesterday, in an order, banned 3 individuals and 2 entities in a case of front-running trades in LIC being perpetrated allegedly by an employee. So there's a clarification that has come from LIC as well, but Sajid is joining us now to add more perspective. Sajid, what's the case all about?
This case pertains to an interim order that was passed in April of 2023, where the regulator, Securities and Exchange Board of India, came out with a ban on 5 entities, which included an employee and his relatives who were involved in front-running of stocks. What is front-running here? Basically, you place a trade before the institution places a trade, and you sell. It could be a buy or a sell side trade that happens, and that way you benefit from that trade, because the institution comes in bulk and that moves prices, and that thereby you gain from that. These 5 entities which are closely related to the former employee of LIC, were trading in these in many securities, and they made an illegal gain of nearly 2.44 crores, which was eventually impounded by the securities market regulator. Now the regulator has confirmed this order on these 5 entities going forward, and they've asked them to cease and desist with respect to engaging in any fraudulent or manipulative practices, including front running in any of the stocks. LIC has come out with a response saying that it has put in a lot more stringent practices with respect to governance and access to people who have to this sensitive information, because it's a large institution, does a lot of trade on a daily basis, so they have put in more security around that, and they have been they have also taken a disciplinary action against the employee by terminating his employment.
Thank you, Sajid. That was the update coming in on what the SEBI has confirmed on LIC. This could have a material impact on stock performance. Very, very likely. The stock has anyway been on the sell side for the last few days.
It's only 2 crore rupees.
I think it's the
systemic
failure.
Yeah, did you have a systemic failure? Came to know Mayuresh's views on this as well. Mayuresh Joshi now joining us on the show. Very good morning to you, Mayuresh. Aditya also with us. Let's just, Mayuresh, start with what you're making of LIC and whether you think this will have any kind of an impact.
Morning, Tamanna. Maybe sentimentally, but I think both the management as well as the regulators have sprung in action, and there will be obviously mechanisms put in place, and it is part and parcel of the system. So I think there are these odd instances which keep on happening, but nothing detrimental in my opinion which should impact the stock structurally.
About 15% in the last month. It had just about come to its IPO levels. So, for early investors, it's been a bit of a pain. Aditya, on the charts, do you like LIC?
Not really, Tamanna. Morning. So I believe the stock will see some kind of a consolidation, maybe a bit of correction as well. Too early to latch onto the stock immediately. I would want the stock to start making higher highs, higher lows. As you mentioned, stock had barely crossed its IPO price, and from there we are seeing good correction in the stock. The only interesting part that I look at in the stock is volumes are thin in the correction. So that means people are not selling on heavy volumes. So that is something interesting. On the downside, 850 is something that is a very strong support for the stock. So if it manages to hold on to 850 levels, then there could be a case for a fresh buy in the stock. For people who already hold on to the stock, already have the stock, hold on to it. If the stock was close to about 850.
Okay, watch out for that. Today, interestingly, there is a note from Nomura which says that they want to go long on oil marketing companies because they believe the corrections are overdone and now there is value here. Now, Mayuresh Joshi, I want to come to you. Is this a good time to do that, considering the stocks have fallen, but that crude prices are rising? So yesterday's impact wasn't because of crude prices being above that $86, $87 per barrel. Is there value at these levels, or would you shy away right now?
Morning, Niraj. So I think out of the entire PSU pack, I think OMCs is, from a valuation perspective, one of the only sectors within the PSU basket and a few of the PSU banks which probably have valuation comfort at this juncture. But coming to your question, I think oil prices on the boil does not augur well if they sustain and remain around these same levels. And secondly, I think if you're probably looking at how the refining margins are poised at this juncture, Singapore GRMs have come off significantly. There is not significant outperformance as you see on the Singapore GRMs that these oil marketing companies post as far as their own refining margins are concerned. And if Singapore GRMs are expected to remain subdued, the refining part of the business is expected to show very subdued performance going forward. The second element obviously is how oil prices are linked with their downstream product pricing as well. And as it comes to the petchem part of the business as well, it largely depends in terms of the demand-supply dynamics. Demand still remains a little bit soft at this juncture, and therefore having a significant outperformance from their petchem business is something which is far-fetched at this juncture. The pipeline volumes might be fine with crude prices the way they are, and the optionalities that India has probably in terms of importing crude as well. But a large part of the business probably might just have some element of softness if these variables stay in place. Obviously, dividend yields for stocks like IOC, BPCL remain extremely strong. But the key variables in terms of balance sheet performance, in my opinion, might remain a little bit soft. So even if valuations, dividend yield are factors which might be very, very supportive for OMCs, I think the structural elements in terms of earnings growth might be a little bit soft, which might keep the prices in a very range-bound or a consolidated fashion.
Aditya, any possibilities of further downsides in these OMCs, or are they near some support levels?
A couple of stocks, Niraj, have close to very important support levels. We first talk of BPCL. 550 is a very important support level for the stock. For the longest period of time, it had not been able to cross that resistance line. After that, it saw a sharp spike. Now that it is coming close to 550, I'll closely watch out how the stock behaves around those areas of 550. If that support level is held for a couple of trading sessions, I guess it will offer a good risk to reward ratio, and one can actually look at initiating fresh long positions in the BPCL with the stock just below 550 and can scale back to levels of 640 again. The second stock, IOC, again, that is close to its very important support level of multi-year high, which it had crossed, and now it is again back to those levels of 152, 153. So I believe, again, one should closely monitor this support level. If stock, again, comes close to that and manages to hold on to the support of 150, 152, then it makes case for a fresh entry in IOC as well for a target, again, back to 180 on the upside.
Right. Stay with us, gentlemen. We'll also quickly highlight some of the stocks that could be in focus today on back of brokerages. Jefferies, I believe, has initiated coverage on Keynes Tech and Sirma. Agam is joining by with more on that. Agam, these two counters could be big movers in trade. What makes Jefferies positive on the EMS sector?
Right, they certainly could be in focus because firstly, when it comes to the EMS sector, Jefferies regards that as a sunrise one. And moreover, they say that it is likely to benefit from the government's indigenization focus. In fact, they're expecting the electronics production to come through at around $300 billion by the year of FY26 as compared to just about $100 billion in FY23. Now, on the back of that, they have initiated coverage on two companies. The first one is Keynes Technologies, where they initiate a hold rating with a target of around 2,900 rupees per share, about 300 rupees higher from where it is currently. And they say that while Keynes does enjoy the highest operating margins amongst all EMS players, and this is largely on account of an optimal product mix along with component diversification, which has in fact aided margins. However, the company's working capital is stretched, and the valuation of around 70 times FY25 price to earnings just as looks a tad bit rich on that account, which is why they have a hold rating. But on the other hand, they have also initiated a buy on Sirma, where they have a target of around 640 rupees per share. They say that the company once again is very well diversified across various verticals, and so a lot of these verticals would include consumer electricals and something like auto medical, and a lot of these contribute significantly to the company, and they have incremental focus on niche verticals, which is why they have also assigned a price to earnings ratio of around 44 times, which is also at quite a discount to Kaynes Technology. And that's also the reason why they have a buy rating on Surma.
Agam, thank you for that. Jeffrey has initiated a coverage on Kaynes Tech and Surma. Quick take from Aditya on both of these counters, and let me add Tata Tech as well, if you're looking at it, because Tata Tech, maybe you won't have much data on the charts truly, but JP Morgan out with a note today where they've marked it as an underperform. Aditya?
Let's talk of Kaynes, Tamanna first. Coming close to support levels, for sure. Stock usually has been moving in an uptrend, and now it has come to an important support level of 2470, 2480 on the downside. So I believe this is something which is definitely looking interesting. Kaynes Tech, one can actually look at it. But again, it will be more of a positional trade. I'm not looking at more of a trading bet here. Talking of Surma, that I will avoid at current levels, maybe closer to about 426 is something that I will look at. And importantly, talking of Tata Tech, that is, maybe I don't have much data, but I'll just quickly pull out the chart and look at it. It's going through a consolidation, Tamanna. I don't see too much of a downside in Tata Technologies at current levels. I believe this is one stock, if it starts to trade above 1080, I will be a buyer in the stock rather than a seller in the stock. So above 1080, with a stop loss closer to about 1020, look for a target of 1200 on the upside. Offers a good risk to reward at current level. So I don't see too much of downside in Tata Technologies.
Yeah, and interesting because the target price that they have put in is about 800, and of course less data because it's relatively recent listing. Mayuresh, on this space, the Make in India push, the push on ER&D. Overall, of course, very, very bullish. But the question is, which players will really come out on top?
So I think the space is very interesting, Tamanna, and there is a huge market opportunity. So you're talking about 3 times, 4 times the market size over the next 5 to 6 years. And I think all players within the EMS space, whether it's Kaynes, or Avalon, have presented these opportunities both in their calls and their presentation as well. And the verticals that they're present in, industrial, manufacturing, energy as a space, all these spaces are expected to move quite significantly. As an example, the semiconductor push that is now expected to take place in India, I think that can have a huge say in terms of how the entire ecosystem probably functions at this juncture. Obviously, all 3 companies have different dynamics when it comes to operating performance, whether it's margins or the bottom line growth. But the underlying trend probably remains extremely strong. I completely agree with Arnab. I think Kaynes is extremely expensive at this juncture. But I think stocks like Avalon, as an example, or even Surma to a certain extent, I think there is a certain element of growth dynamics which can come through over the next few quarters. And they're very, very specific and niche in terms of their product offerings as well. In fact, if you go on to their presentations, 2 or 3 slides in Surma and Avalon are dedicatedly given to how the entire PCB manufacturing process probably takes place. So I think there is a huge opportunity out there. Avalon or Surma probably sound and seem to be a little bit more lucrative compared to Kaynes at this juncture.
Right. Mayuresh, one other space that we've been debating about has been the tech space. Rotationally, we've seen some gains coming into a few of those tech stocks. But fundamentally, nothing much has changed. In fact, we've not heard of any major order wins between last quarter and, of course, from where we stand. In fact, another data point that I saw was H1B visas have been on a downward trend since Trump's win, which also means that operationally margins could be compromised further going ahead. Do you think a sustainable recovery is around the corner for the tech sector? Maybe a good time to start accumulating gradually, or it's still way out for the next couple of months?
So I think this quarter might be a little bit tough. Morning to you, Samina. What probably transpires is Q4 typically is where the discretionary spending patterns are determined. And to a certain extent, we'll have to wait and watch in terms of Q4 numbers and the management commentaries thereof on how the environment is probably shaping up. Obviously, from a demand perspective, as far as the large IT companies are concerned, when it comes to the multi-billion-dollar deals, we are still awaiting in terms of whether we're seeing any kind of a pricing pressure on that, or whether there is some delay in terms of awarding these orders or reorders that are coming through for the existing players as well. Having said that, the expectations in terms of dollar and constant currency growth, at least for Q4, seems to be a little bit muted. The expectations in terms of a genuine recovery expected to come through in key sectors like BFSI, manufacturing, retail, and key geographies like North America and Europe still seems to be on a very, very soft footing. And therefore, I think the expectations largely is a very softish or a very okayish commentary sort of from a whole host of large cap players at this juncture. And therefore, I think a gradual recovery can only be expected Q2 onwards, in my opinion, in the next financial year. So to that extent, I think there might be a strong and a long consolidation that these players might go through at this juncture. Mid-cap IT companies, Samina, have outperformed. Commentaries have been quite reasonable. The management sound very, very optimistic when it comes to both the pricing and demand environment. And because they are typically dealing in lower deal win orders, typically I think those are not affected in this market scenario. But I think a lot of companies, the valuations are through the roof, and they trade much higher above pivot levels as we see it. So we'll wait for pullbacks on the broader IT company stocks like a Persistent, but large cap IT might go through a phase of consolidation.
Mayuresh, to add to Persistent, even a Birlasoft, we'd spoken to the management last quarter, and they seem to be, winning deals, improving margins, having great conversation, and that's reflected in the stock. It's up 50% in the last couple of months. So you're right, some of the mid-cap names may be a little more, might be in a position to do better in the going ahead. Aditya, you want to come in on some of these tech names? And I'll start with TCS because they've surprisingly announced an order win this morning with the regional bank in the US. So, and of course, after a 4% correction yesterday, a little bit of a pullback technically as well cannot be ruled out. If we get a flat, a small gap up, would it make for a good long trade?
Morning. Definitely. I believe I will stick to large cap IT names. And I agree with Mayuresh that it can go through consolidation phases. But I believe it's time to add to these names during consolidation, to start with TCS. Definitely, I believe it's come close to good support levels of 39.50, 39.40 on the downside. So having said that, that is close to its support levels. I would not shy away from getting long in these stocks. Could be more of a positional trade here, Samina, at current levels, add on to it, look for a target of 4,100 or 4,200 on the upside. Same holds true for Infosys as well. I believe good times to add the stock in your portfolio. Mind you, I'm not saying that stocks will turn around immediately. Stocks can go through sideways to minor profit booking phases, but my sense is the profit taking that you will notice in other sectors will be much higher as compared to the IT space. So IT space will provide you that cushion from shallow corrections, and it will give you an opportunity of outperformances going ahead, maybe in the next 1 quarter. So the IT space is something that I will closely monitor and stick to large cap IT names, to name a few, as I mentioned. Infosys, TCS would be the top bets within the space.
Right, stick to large cap IT technically. Infin, TCS are Aditya's top bets. We're gearing up for pre-open trade. We'll take a quick break. We'll come back. We'll continue talking to Mayuresh and Aditya and also gear you up for trade this morning. So stay tuned.
right, we're just a few seconds out on a pre-open, and this is going to be an interesting day. Indian markets have, for the majority of the last many weeks, been marching to its own tune, but right now global cues may have come to the forefront of what direction we take, especially with a key Fed meet up. So let's take a quick look at how we're opening this morning and wait for those rates, of course, to settle. The implied open indicated maybe a positive start, but what's going to be a big factor perhaps just right in the beginning of trade is going to be directions from a lot of brokerage notes, a lot of interesting notes out this morning. So Bajaj Auto or Dabur, some of those could be on the radar. Bajaj Auto has a positive note come out with an increase in its target price as well. So does Dabur. And, we'll see how all of those sort of pan out and whether there is any movement there. Meanwhile, let's continue our conversation. Mayuresh, Joshi, Aditya, Agarwala are with us this morning. Mayuresh, one space that I want to talk to you about, which has, I would say, lost its sheen in the last few trading sessions, is your PSEs, your government-run companies. You saw one unidirectional sort of a move for the last several months, and then in the last 3-4 weeks, it's sort of turned. Would you look at anything right now in this space, or wait and watch?
So to be honest, Tamanna, we did profit booking a few weeks back as far as the PSU space is concerned. And to a large extent, I think the kind of moves that the space gave, the fundamentals were in place. So I think structurally places like green energy as an example, defense as a space, banking as a space, give stellar returns. But to a certain extent, the valuations, at least from a very near-term perspective, were looking a little bit stretched. The second element obviously is, again, for all these spaces, the only factor which can be a detriment is execution. And if execution falters for some reason or the other, the sell-off can be equally brutal as well. However, having said that, as I mentioned in my opening remarks as well, I think PSU banks as a space is something that we are still keeping our eyes open for. Any pullbacks within this mid-cap universe still offers a decent risk-reward in our opinion, because a lot of cleanup has happened as far as the asset quality pressures are concerned. In expectations of the provisioning that a lot of these banks have done are extremely high, and therefore any kind of recoveries, upgrades that a lot of managements have put forth directly aid their bottom line growth. Capital adequacy remains quite reasonable, and the deposit scenario, which seems to be an issue for large cap private banks, seem not to be such a kind of a detrimental issue for these PSU banks. So we're keeping our eyes open in terms of the PSU banking space. Any pullbacks on stocks like a Bank of Maharashtra, as an example, is something that we'll see as a buying opportunity. But within the space, I think PSU banks still offer a reasonable amount of service.
Okay. Just quickly want to see what iShares is doing in the pre-open session. So UBS has upgraded iShares from neutral to buy with a target price of 5,000, and decent move, at least in the pre-markets session. The biggest reason is that, at least that UBS has, is that rival launches have not been able to ramp up any volumes meaningfully. Aditya, are you looking at iShares?
Not a bad trade. Again, it's close to its 200 DMA, so it offers a good risk to reward ratio. On the downside, 3,600 is a good support area. On the upside, stock can test levels of 3,900 to about 4,000. So I'll play with those levels first. 3,900 is something that is a major hurdle for the stock. Once that is taken out, then we can be in for a clean up move on the stock for 4,000 and beyond. But not a bad trade, Tamanna, to take. Offers a good risk to rewards. The entire space, as you mentioned in the start, Bajaj Auto is something also which is interesting, can offer good risk to reward at current levels. So this entire space is not looking bad. In fact, autos have been holding ground for a couple of trading sessions. So I believe autos can pop out and give you good returns.
Picks in autos in that case, Aditya, since you're liking the space?
Maruti Suzuki is something from the four-wheeler space which is very interesting. So I would like to go long on Maruti Suzuki at current levels. Look for a target of 11,800 on the upside with a good support on the downside at close to about 11,400. So that is one stock that I'm definitely eyeing on. The second one is again Bajaj Auto has been showing good traction on the upside. I believe stock can be bought at current levels. Look for a target of at least 9,000 on the upside with the stop loss close to about 8,500 on the downside.
Mayuresh, you quickly want to come in on Zomato? There has been, of course, there was a massive upgrade that came from Jefferies a few days ago. This morning, there's the back and forth on the pure vegetarian fleet. Sentimental, I'm guessing, largely, but from a more medium-term time horizon, does Zomato look attractive at these levels?
So, Samina, from a disclaimer perspective, we are invested in the stock at lower levels, and therefore the view might be a little bit biased. Obviously, the kind of dynamics that Zomato has gone through over the previous few quarters has shown a very increasing propensity in terms of the Blinkit business actually improving every passing quarter, and the hyperpure business as well. So the expectations in terms of these businesses breaking even over the next few quarters, if that seems to be a reality, and as the management is speaking their way through in terms of delivering on this performance, if that happens to be a reality over the next few quarters, there is a strong probability in terms of how numbers for 26 and 27 will play out. Obviously, as a space, being in the aggregator food business, if QSR and consumption as a space is expected to be growing at a very healthy pace across tier 2, tier 3 towns as well, the platform aggregator services, whether it's Zomato or Swiggy, should have a reasonable performance as well. Zomato being listed has shown significant dynamics as far as core numbers are concerned. And therefore, numbers should show an increasing propensity in terms of reasonable growth as far as the margins at the operating level and as far as the bottom line growth is concerned. So we remain positive and optimistic on this.
Well, 159 and counting for now. A part of the selling that has happened in Zomato is now behind, and maybe that helps. But it's 9:05 or thereabouts. So sometime at the time that we do a key brokerage note, today there are a ton of them, but Harsh has identified the JP Morgan view on ER&D companies. Now, Harsh, they've gone wrong a lot of times on this space, but what is the note saying?
Yes, it's an extremely interesting note, Niraj. They are suggesting that the tailwind with regard to ER&D is going to pick up in calendar year 2024. They believe demand traction for ER&D growth will definitely be higher than your general IT companies, and therefore ER&D stocks will be in focus. What they are liking in this space is when it comes to Cyient is something they like, but I'll first come to Tata Tech because that is the major one. They've rated it an underperform. A 24% downside is what they are factoring into this stock. 800 is their target price. What they are suggesting is that the client concentration continues to remain very high. 46% of revenues comes in from largely two clients and which are group entities as well, and therefore that's a major negative according to them. They also believe that you have certain non-anchor clients like a VinFast, but those are exceptions. And the revenue from them is chunky, but outside of that, those are just exceptions. You only have VinFast as part of that above $20 million kind of clientele. Low earnings CAGR is what they're projecting, just about 16% in terms of earnings CAGR versus the peer group average of roughly 18% earnings CAGR. So they therefore believe that earnings may not grow as quickly, and they believe that valuations are expensive. 53 times 1 year forward is what they're pegging it at. High client concentration, and they're expecting that this 53 times virtually means a 20% CAGR over the next 10 years with regard to revenue. So they believe that that is a tough ask. With regard to the outperform here, Cyient is what they believe is an outperform. The diversity with regard to which Cyient caters to different sectors and segments, aero, telecom, auto, sustainability across the board, they have presence, and therefore market is far larger for Cyient. That's one. Second is with regard to just the manner in which they've been going about business. They are doing larger and more longer term contracts, and that should therefore aid business. They're expecting a growth of 9% FY25, 13% FY26, and therefore they believe growth is going to pick up. And valuations, they believe, are inexpensive at this point, just about at 20 times price to earnings versus the peer group of 35 times price to earnings.
Harsh, thanks for that. So, Cyient certainly comes out in this note as something that JP Morgan likes, and that stock in the pre-open session is up about 1.78%. Wonder if Tata Tech is reacting at all since the pre-open rates have settled. No reaction there. Let's see if KPIT and the persistence of the world have also reacted to this piece of news or no. KPIT, well, no explicit note out there, but the stock up about 1%. Persistent Systems, flattish. So signed it is from this note's end, which is looking okay. A couple of other stocks that we should mark. Let's see if LT Foods is reacting to a Bacchus buying into that. Stock was down 4%, up 9% in the pre-open session. So that's interesting. The other one is Time Technoplast, which has made this announcement around doing one of the first company to come out with some green hydrogen related technology. And that stock is up 5% as well. Interesting moves there. Mayuresh, fundamentally, any thoughts on either of these? Have you looked at them fundamentally, LT Foods or Time Techno?
So I had looked at the Niraj a few months back. I'm not interested in them.
Okay, not recently. But there is a bit of a spurt out there. Aditya, I wonder if LT Foods, which was down 4% yesterday and up 9% today, does it give you a chance to trade the stock?
I would wait it out, Niraj, and see if this 9% up move sustains throughout the trading session. If it does so, then maybe there can be a case for a long trade here with a stop loss close at about 170, because this 9% up move will take the stock back above its 200 DMA. And yesterday it just ended below its 200 DMA on good volume. So maybe if it sustains above that level of 170 post pre-open 9% gap up, I could look at getting into the stock for a target of 200 on the upside. Not a bad trade to take, to be honest.
Yeah, Aditya, you're just about closed on the pre-open session. The markets have settled and you're looking at a very, very flat day with not too much movement. Perhaps cautious note at least there. But what would be your top picks for the day?
So I've got a buy and a sell, Tamanna, because clearly we don't know really which direction the markets are moving. One day of up move, one day of down move. MFSL is looking interesting at current levels. I would like to go long on the stock for a target of 1070 with the stop loss at 910 on the downside. Breaking out from a narrow consolidation phase. I would sell on IndusInd Bank, despite the fact that most of the banking stocks are looking solid and maybe can show an up move. IndusInd Bank is actually looking extremely weak on the charts. And it has broken down from its 200 DMA in trade yesterday, also a support consolidation phase. It has broken down from that. So I'll go short on IndusInd Bank for a target of 1345 on the downside with the stop loss at 1490 on the upside.
Okay. So that's those are the couple of calls from Aditya Agarwala. And as the pre-open rates settled, mind you, the OMCs is the other pocket to look at. And let's see if there is a semblance of sanity after the kind of insane downticks that we've seen. So bring up BP, HP, IOC, and let's just see if those stocks are moving at all, because they were cracking in trade yesterday as well. Bharat Petroleum, Hindustan Petroleum, and IOC. And in today's session, they are starting off on a flat note. So keep an eye out for these as well. No big moves there, but interesting. Mayuresh, this corrective move, is there something that has stood out for you fundamentally? Have you gone out and added positions anywhere?
So largest mid caps, Niraj, is somewhere we are looking at at Marketsmith India, and Pidilite is something that we are liking at Marketsmith India. Two, three interesting aspects. One, I think the volume growth that has come through for the previous quarter in excess of 10%. Is that sustainable in our opinion? And hearing transcripts and looking at the environment, it seems to be sustainable at this juncture. Standalone EBITDA margins in excess of 25%. Obviously, you've seen some element of an uptick in crude. So what happens with VAM prices or crude derivatives might be a little bit of a dampener if crude prices stay this way in the next few quarters. There's obviously an element of pass-through, which means that the EBITDA margin should be sustainable at the standalone level, around those 25% mark as well. And generally, I think if volumes sustain along with those margins, there is a sustainable earnings recovery that can probably come through with the expectations of more products expected to come through. So we remain a little bit more sanguine in terms of what Pidilite can show in terms of its operating performance in the next few quarters.
All right. Well, 58 seconds left. Aditya, you gave us your two ideas for the day. Is there one top stock based on the pre-open rates? One top trading stock for the day?
Can be an MFSL, Niraj, because of the fact that it has been standing tall. I would, if I have to trade one stock, it has to be MFSL for a target of 1070 on the upside.
Okay, so one stock, 1070 target. That's MaxFin 966 is where it's trading currently. Gentlemen, stay on. We'll talk a bit more about some specific movers. As an investment idea, Pidilite from Marketsmith, Mayuresh spoke about it. And as a trading idea, Maxfin. So watch out for these two. Now today, watch out for IT. And let's see if there is a bit of a follow-up selling if it comes. Pharma was the other one which took it on the chin yesterday. The likes of Cipla and some others were certainly down. So let's see if there's a further follow-on there. And whether banks, which withstood any kind of selling pressure yesterday, do they actually perk up in trade today? Or is the action firmly in the small caps? We'll know in just moments from now. Here's how the markets are starting off. Flattish move, 45 odd points for the Nifty, Sensex 0.2%. And the Bank Nifty and Nifty IT will come up on your screen very quickly. Flattish for the Bank Nifty. Let's leave that out. Nifty IT, 0.5% higher. Well, certainly seeing some bounce back in the heavyweights. We'll get to them. Mid caps and small caps will come up on your screen in just a moment. The indices, just to see how they are starting off in the session today. Small cap index 0.65%, not bad. The mid cap index 0.46%, not a bad start. You have to say the market breadth is positive. Bring up the heat map and let's see what's moving on the indices. On the gaining side, the UBS note on iShares leading to a 4.5% uptick on this one. A Nomura note on OMCs, arguably probably working for BPCL. Can see no other reason why BPCL, HP, IOC might be up. Even HP and IOC might be up, I'm presuming, but BPCL is certainly up. There's some strength otherwise in IT. So HCL Tech is the top performer, but there is also TCS, which is perking up a little bit, Wipro, which is perking up a little bit. So watch out for those two as well. And some metal names out there, Tata Steel and JSW Steel, also in the green. Not too much in the red. Grasim 1.4% lower. ICICI Bank marginally lower. But yeah, not too much in the red. And HDFC Bank and Reliance, the two heavies, are flat. So clearly, iShares, Maruti, maybe autos, Hero MotoCorp standing out, IT standing out, and all marketing companies, Tamanna, I reckon, would be in the green because BP is certainly picking it up 2% higher now.
So, Grasim, I'm just wondering, yesterday there were details out of the discount that their paints product is going to have compared to the incumbents, and perhaps that's weighing in. We'll have to wait and see, but 1.5% down this morning. Let's just quickly look at what's happening with mid-cap and small-cap indices before we get to specific stocks that are on our radar this morning, because you've seen the broader markets largely under pressure, but they're having not a very bad day compared to your front lines, and you're seeing both of them a little over 0.5% up. But specific stocks, and let's start by talking about what's happening to Zomato. So as a target audience, focusing on a pure veg segment is a good segmentation that's working out in the stock. There's been a clarification from Dipinder Goyal a little before the trade session began that there will be no segregation in terms of the fleet. Everyone will wear the same Zomato red color uniform, but the pure veg kind of play perhaps working well. Anyway, the stock has been on an up move with a Jeffries call and a whole set of house notes saying that it is a good play. We are also looking this morning at RR Kabul. Let's look at RR Kabul and what they are doing. Citi has initiated coverage, a buy target of 1,728, target price of 1728. That's doing well. iShares, Niraj just spoke about, but even between those few minutes, look at what's happened to iShares. Nearly 5.5% up on that UBS note. Ultratech and Kesoram was the other one that we talked about, a bit of a issue of CCI clearance now behind them. That acquisition can go through, and you're seeing those two in the green. Really, notes have been dominating this morning's trade. So I want to see what Tata Tech is doing, what Cyient is doing as well, both with the JP Morgan note. Tata Tech was actually negative, but that stock is up in the green, and Cyient was positive. That stock up about 3%. I think even a Sirma would be doing pretty well, Samina. That entire space today may be one mini sector and mini story of this morning.
Indeed, they are actually doing quite well. So Sirma, like you said, is up about 3%. But a quick check on some of the other names that are seeing traction this morning, and I'm not sure what's happening in Welspun Living. But the stock is turning out to be quite the gainer of the Nifty 500. It is your second biggest winning trade. Welspun Living up 4.5% is what we have. iShares, of course, stealing the thunder in early minutes of trade. UBS anticipates a 34% upside from its current price. and on back of that, you are seeing a good move on Aisha. Well, a quick check on how some of the other names are also looking like. If I can get them on the screen, that should be helpful. We've got some of your OMCs. So like Niraj said, BPCL was having a great morning. HPCL should not be too far behind. If we can get HPCL up, yes, 2% higher on HPCL is what we are. This is despite the fact that crude trades at $87 a barrel. Yes Bank is looking good with a 2% up move in trade right now. So that's the other counter that we are picking up on in early minutes of trade. Yes Bank seeing a gain of 2%. India Bulls Real Estate, if we can get that one up too. So some of those real estate names aren't doing too badly in trade. 2.5% on India Bulls Real Estate is what we have. On the sell side, it's Tata Investments again. If I can get Tata Investments up on the screen, that should be helpful. Let's see what the stock is getting up to. There you go, lower circuit again, day 6 and counting. 30% has been given up on Tata Investments in the last couple of days. So 5% there. Hutco doesn't look too bad. Sirma, though, up 3%. It's off the day's high point, but still looking really good in trade. Adani Group companies not doing too badly either. Stocks like Adani Green trade marginally higher. BML is also up 4%. That's BML. If you can get BML up on the screen, that should be useful. 3.5 to 4% gains coming in on that one too. EIL is up 2%. All in all, it's looking okay. No runaway gains for any of those broader market names, but looking intact for the first 5 minutes.
Time Technoplast is doing well this morning. They've received an approval for manufacturing high-pressure composite cylinder prototype to store hydrogen. Let's just pull up Time Technoplast and see what's happening there. In fact, this data point that our team has put out, all sectoral indices have opened up higher. Yeah, there. Time Techno up about 8%. So some of these maybe counters showing some spots of, a spring. Aditya, Agarwala, anything on your radar post the open?
Maruti has to be Tamanna. Look at the way the stock has been charging ahead as we speak, making highs. I guess if you've not picked up the stock yet, it's time to get onto the stock. Targets can be raised to 12,000 now, and I believe once 12,000 is taken out, 12,100 could be your next target. And it has broken out from that consolidation resistance, which it was not able to do that. So 11,700 will be a stop loss. And look for a target of 12,000 first and then 12,100. From the large cap space, this is something which is looking really interesting now.
Okay. Okay, so watch out for Maruti, but just the blowout move in autos this morning is very, very interesting. Mayuresh, I wonder if Eicher, and I don't know if we spoke about this earlier, but if we haven't, Eicher Motors, for all the talks around heightened competition, etc., it kind of finds a way to come back, the stock, I mean. Is this a good time? Because I don't think it's really moved the needle too much in the last 12 or 18 odd months.
Yeah, not really. And again, I think competition is there, Niraj, specifically in certain segments, specifically in terms of the 500cc, 750cc as well. And the new variants that they've probably introduced have probably done better than what the street was probably expecting. So a large element in terms of how Bajaj Auto's product is going to get perceived. Obviously, the order bookings have been pretty decent so far. And what happens with the Harley launch as well. I think all these elements are something that will probably ensure that competition probably remains stiff for the higher CC models as far as the Indian context is concerned. And therefore, I think how numbers play out is going to be extremely important and critical in the next few quarters. Having said that, I think the kind of diversification that Eicher has embarked upon, they've actually started looking at exports markets very, very aggressively over the last few quarters. And spares as a part of their business along with accessories is almost 10% of their top line now. So I think there is some element of diversification that is probably coming through. But what probably comes out in numbers and whether these numbers are going to show a compounded rate of growth over the next few quarters, I think that still remains to be a case where I probably remain a little bit circumspect. So probably looking out for the auto ancillary players at this juncture.
I'm going to do a little bit of a detour and talk to you about Tata Chemicals. The stock, along with a few others, rallied up quite sharply in anticipation of that IPO from Tata Sons. The Spark report sparked that Tata Chem could be a key beneficiary. Since it becomes more and more apparent that an IPO is not on the cards for Tata Sons, Tata Chemicals has been selling off. Now, if investors had picked this up to play the Tata Sons IPO, what do you recommend they should do? Because while fundamentals, soda ash prices are really not going to be moving up anytime soon. So business-wise, it looks weak. But if you've got it, do you hold it and do your time, or you exit Tata Chemicals?
You'll have to be an extremely patient investor, Samina, as simple as that. Because I think what probably transpires, and as you rightly put forth, soda ash prices have been on the decline, not just over the last few days, over the past few quarters and months as well. It's a highly commoditized industry, and China is one of the biggest players as far as the soda ash market is concerned. You've probably seen lower demand, lower pricing affect numbers as far as Tata Chem's international operations are concerned. And therefore, to that extent, the soda ash part of the business is going to get affected in the next few quarters as well, at least for the next couple of quarters, to say the least. What happens in terms of the sodium bicarbonate business, the salt business as well, I think that might be a little bit better as far as the domestic scenario is concerned. But globally, again, I think pricing still remains to be a key issue. Specifically when it comes to the African stroke, the European markets as well. Last but not the least, I think the expectations in terms of the capex that they probably have put in place in terms of their specialty business expected to garner some element of pace and some shape as well. I think that is going to take some element of time to translate very categorically in terms of growing numbers. And therefore, I think the pain in terms of numbers delivery might continue at least for the next 2 or 3 quarters. So I think investors who probably got onto this stock at higher levels should probably have that extreme levels of patience to now write this down.
There's a cautionary note there also for investors if they have gotten onto these stocks instead of fundamentals of some very solid companies, but instead of waiting for some IPO play. And then, you have the risk of things like this happening. Having said that, Aditya Agarwala, I'm just looking at the reality pack, having a good day after quite a few sessions. iBulls yesterday was completely beaten down in the closing session, up about 3% today. Mahindra Life, Sobha. Anything you like over here, and what do you make of an iBulls?
Let's talk about iBulls first, and then we'll talk about what I like within the space. I would avoid Tamanna, to be honest. Look at the way the stock has been moving. Extremely volatile, and in a market like this, you don't want to get into a stock which is up 10%, down 10%, and then back up again. So this volatility I would want to avoid, and especially in a real estate space. So iBull is something, if you already have, then maybe you can place a stop loss close to about 105 on the downside. If you don't have a real estate stock and if looking to get onto it, I would avoid Enable Real Estate. If I have to pick a stock over a realty, something which is looking interesting to me, Tamanna. Stock has been making high highs, high lows, and recently it did enter into a consolidation phase. My sense is once it starts to trade beyond 1390, which is the immediate hurdle for the stock, it can again go back to levels of 1600 on the upside. So over a realty from the real estate pack is something which is definitely standing tall, and I think this is one stock which to look at from the real estate space. Otherwise, I'm not too gung-ho on the real estate space overall. I believe one should be very selective in this space and a little cautious because, as I mentioned, every election year and plus after every alternate year, real estate packs usually tend to underperform in the second half.
Yeah. Absolutely. So yeah, that election mode will also impact. But today, at least, real estate is having a good day. Mayuresh, any take on real estate before we let you guys go?
No, so ancillaries, Tamanna, is a better way to play this, and I totally agree with Aditya. I think a large part of the move has now probably taken place. I've been hearing some reports where there is some stagnation that is now taking place, both in terms of new registrations that are probably happening, and because of the excessive supply that has come through, specifically in Tier 1, Tier 2 cities as well. A lot of redevelopment projects, not just for the listed players, for the unlisted players as well. The supply and the inventory has started to pile up. So to that extent, I think ancillaries as a play becomes a little bit more attractive at this juncture. And there is a whole host to probably choose from. So there are these plywood players, the ceramic players, the laminate players that can do well. 2-3 things which can act as tailwinds, honestly. I think the input costs were a big issue for most of these players. They have started stabilizing. we are expected to see some element of volume growth now actually start coming through. And therefore, the leverage, the operating leverage dynamic should start getting played out with better margins coming forward and expectations of stable and increasing volumes over the next few quarters, both in terms of new houses, more work done in those houses as well, and refurbishment happening in the existing houses as well. I think ancillary plays probably offer better risk reward at this stage.
All right, so keep a track of the ancillaries in real estate. We're going to have a chat with Anuj Puri in a bit after this, so we'll take that conversation further. But meanwhile, Mayuresh, Aditya, have a great day. Thank you for joining us on this leg of India Market Open. We're taking a very short break, but before we go into that break, everyone's talking about the Fed and where interest rates will go. I had the opportunity to speak exclusively in the first interview he's given actually after taking over after 16th Finance Commission chairperson in that position. Arvind Panagria spoke with us, and I asked him where he thinks rate cuts are heading as far as India is concerned. Should we wait for the Fed, and what he expects the Fed to do. Listening.
So first, inflation, I'm quite okay. We are currently 5.1% if I go by the monthly figures in January and February. I've never been an inflation hawk in the sense of, taking it down to 2% or 2.5%, 3%. If we get there without pain and with rising incomes and rising employment, that's all good. But certainly 5% is very much within my tolerance, my personal tolerance limit on inflation. I in fact think that that kind of inflation generally is helpful because in a growing economy, an economy that's growing in real terms 7 to 8%, you need to give some space to the prices to adjust, meaning the relative prices to adjust. If inflation is extremely low, given the fact that very few prices have the tendency, except the agricultural prices, but other than that, most other prices don't actually fall. And so therefore, the adjustment in the relative prices usually takes place through rising prices. So some room for the relative prices, which are ultimately the signals to the investors that where should the investment go. There actually is a signal that the relative prices pass on to the entrepreneurs. It works well if you got some rise in prices of 4 to 5%. So currently we are 5%. I'm okay with that. On the interest rate question, really, I would really leave it to our central bank. Reserve Bank of India has really navigated this extremely well. I'm generally happy with how they have done it, and so I'd rather not second guess them.
Okay. Would you be okay second guessing what Mr. Powell has to do? Or what he should do? We're all waiting for the March policy outcome, the March FOMC meeting outcome. It's not going to happen in March, but when is the question? Do you think that concern or how careful the Fed is being is keeping the world on tenterhooks?
Well, what the U.S. does or what the Fed does impact the entire world economy. So certainly all of us are waiting for what the Fed will do. But, on the other hand, there is not a big mystery on Fed. Mr. Powell has already said that, he sees the interest rates coming down in the near future. Now, if we are talking about, which month is it? That I have no idea. On that, this is all like the astrological predictions. So
you have no number penciled in. You have no month penciled in of later in the year, summer, or when we can expect that.
It will be within this year, whether it will be in the first half of the year, second half, that I won't try to guess.
Welcome back. You're watching India Market Open. We're joined now by Anuj Puri, chairman of the Arora Group, and we're speaking real estate today. Now, 2023 has been a standout year for real estate, highest numbers in the last 15 years or so. The question and the concern now is, are we going to see, or are we seeing the beginnings of a stagnation? With that context set, Anuj, great to speak with you here on NDTV Profit. Let's paint a picture of what 2023 was like and why you think it will sustain.
So first of all, very good morning to you and your viewers. 2023 was a stunning year. Best in the last 15 years. We saw both on the commercial and, sometimes we forget the office sector, which is in doldrums in the Western economies, but in India, continues to do exceptionally well. And on the residential, which had a 15-year high. I think a lot of it is coming in from, the way the Indian economy is growing, the way job market is getting created, particularly in the urban people, and the way the stock markets are reacting, where a lot of people are consolidating the monies from the stock market and, buying luxury apartments. So 2023 was about 475,000 new units in the top 7 cities. But one trend that we have seen that is emerging is that the leading listed guys and also the leading unlisted guys are taking disproportionate amount of sales from the overall, whilst the end user demand still continues to remain very, very strong.
Sure, if you've got hi, it's Samina as well joining in. If I've got to extend that conversation beyond 2023, from the look of it, we are at the beginning of the cycle in terms of real estate demand. But with these elevated levels, do you feel like demand could continue into calendar year 24-25, or it seems like it could be topping out at this stage, even though I do understand the real estate cycle usually extends between 3 to 4 years?
Hi, Samina. It is true is the real estate cycle usually, spans between 3 to 5 years. We are probably in 1.5 years of this cycle, having come out of COVID. I'm not as concerned because in the previous cycles, I've seen 3 cycles now. The investor or the speculator gets in. And once the investor speculator gets in, that over the next 9 months, 12 months, there is going to be trouble that is going to brew. Till now, we haven't seen the speculator coming in, maybe because the stock market is doing so well. Maybe also the developers haven't really increased the prices dramatically. It's 8 to 10% increase in the prices per annum that they're going. As a result of it, the investor speculator does not believe that this is an asset class that is going to yield the results. So demand continues to remain from the end users. And that gives me the confidence that 2024 will continue to remain strong. You'll see the results of the listed guys on 31st March 2024. It was phenomenal what the listed guys have been able to do. It's going to be record one after another when the announcements start to come in. We had not seen launches where you have thousands crores of inventory being sold in like 48 hours, 72 hours. Now several developers, whether it's Delhi, Bangalore, Bombay, when they're launching over 1,000 crore in the first 48 hours inventory being sold and then sold to end users who are coming with their families, with their relatives to buy that as a home.
Anuj, you're right. You have been seeing all of these news reports. We've spoken to some of those developers as well, where they're seeing this huge demand. But it's in a very specific segment. It's in luxury, ultra luxury, premium. And as a share of the complete market, that's still fairly small. The concerns are now whether you're seeing that trickle down to the broader segments or not. Do you think those are valid? Because you're hearing about prices stagnating, you're hearing about sales stagnating, and then of course the concern of inventory buildup follows.
So it's a very important point what you say, Tamanna, is that the demand has largely been in ultra luxury, premium, and I would also say mid-level. And by mid-level, I mean, Tamanna, between 1.5 crores to 3.5 crores. I think where it has slowed down is really on the affordable housing. And that, I feel is that the definition of affordable housing really needs to change. because the way it was defined in 2017, that definition on the price point and on the area has remained stagnant for the last 7 years. As a result of which, people who are wanting to buy in that category are breaching the price, and hence we are not calling it as affordable, we are calling it as mid-level housing. So overall, if you would look at it, we get the headlines because ultra luxury, 50 crore, 70 crore apartments being sold, but there's a fair amount of demand between the 1.5 crores to 3.5 crore category. Below 40, 50 lakh rupee is where there is a challenge that we are finding on both sides. One, supply isn't coming in because developers are finding it very difficult to make profit in that. And second is the demand has also slowed down. Yet I must put in sort of one caveat on that is the demand there still outpaces the supply. So supply is much slower in the 40, 50 lakh rupee category for housing than the demand.
Not building it. The inventory focus is on the premium side. So that's my next question. When you're ultra rich or that category taps out, what is going to happen to all of that inventory which is being built at a frenetic pace?
At this moment in time, Tamanna, we are at a cycle where we have not seen this kind of low inventory levels. In fact, my concern is that the inventory is not coming out as quickly as where the demand is. And I hope that the prices don't escalate quickly just because there is little supply compared to the demand. On paper, the supply looks that there is going to be all coming it up. But in actual practice, we've seen is what we expect is going to come over 1 or 2 years actually spreads out over 4 or 5 years. And that is where my concern is that hopefully this inventory of the land buying spree that has happened, of the redevelopment in Bombay, particularly society redevelopment, that inventory does come out quickly. Otherwise, I just feel is that the prices will start to run up quick, much, much ahead of where the demand is, and that may cause concern for the cycle.
Anuj, hence my follow-up question. Cost of construction is on an upward trajectory. If builders are going to see an oversupply, they may not be in a position to pass on the price hike, like you indicated yourself. Most of the real estate players are functioning at single-digit margins. What does that mean for their profitability? So you might sell more, but hey, you're not going to make more money.
I think most of the developers that you were talked to would say is, look, we want the churn of the inventory. We want to sell the inventory. We want the momentum of the sales to continue. We want the cash flow to come in. We don't want debt. We want to reduce the net debt that we have on the balance sheet. The second point is that they are looking at the profit margin. The first is really on the sales momentum. They don't want to break the sales momentum, which is like, after a very long time, you are in this pleasant experience where the developers are not wanting to, in a hurry, increase the price. What they are although doing is, because as you rightly said, is that their profit margins are in single digit, they're passing on the additional cost of construction to the home buyer. Now, let me just explain is that from 2013 to 2020, really the home prices had not increased, whilst the income levels had continued to increase. Now, from 2020, the price rise has started to happen, 8 to 10% per annum. But the home buyers' income has gone over this period of time, from 2013 to 2024, far greater than what the price rise is happening on the residential side. And hence, their ability is there to absorb. And that I go back to my previous point is that if for some reason the developers start to push the price rise higher than just the increase in the cost of construction, that's where I do feel is that you may see the cycle break. But until now, all the listed developers that you speak with or the large unlisted developers, they're saying is, guys, we just want sales. We will worry about the profit margin once the financial closure of a project is complete. But at this moment in time, let the cash flow come in. We don't want to get into this debt trap that we had earlier got into.
Well, it is, the cycle is there, the positive cycle is there, but it's not going to be easy and a one-way move. And you're seeing that in real estate stocks. And we were talking to analysts before we got into this conversation with Anuj Puri, who were talking about how real estate behaves pre-election season. So you have to put that into perspective as well. Anuj, thanks so much for joining us. Always a pleasure to speak with you. Very quick break, but don't go away because on the other side, we're speaking with the management of CAMS on the approval they got to launch a new facility at Gift City.
Welcome back. You're watching India Market Open. The market's having a flat sort of morning. Stock-specific trade, though, is driving attention. Now, one company that's been one of the few companies from the capital market play has been CAMS. Companies such as CAMS have been in focus on back of investors looking for opportunities to capitalize on the recent surge and, of course, the additions in SIPs into equity markets. And we've got with us Anuj Kumar, Managing Director of CAMS, now joining in. Hi, Mr. Kumar. Thank you very much for joining in. I mean, you are in a great business. I'm sure you look back and just think of what went right, because everything seems to be coming together for a company like yourself at this stage. And I want to start with breaking the business down between mutual funds and non-MF. Let's begin with mutual funds, right? The investor base in the mutual fund industry has grown enormously. The potential for growth is 4 to 5 times, at least that's what we're expecting in the next couple of years. Of course, there are bumps along the way. We had that recent stress test for the mid-cap and the small-cap funds. But nevertheless, the trend, if you can highlight for me the trend in the MF industry, and are you also seeing an increase in adoption of RTA services by mutual funds currently? So help us understand how good does the future really look?
Sure. Good morning, and thanks very much, Tamanna, for having me on the show. So what you say is right. We sense it exactly in a similar manner, that a lot of things, a lot of forces are coming together at the same time. I think in terms of primacy, the biggest force is that the trust of the retail investor in capital markets has kind of solidified over the last 4 or 5 years. At one time, families and households weren't committing serious money. But today you're seeing 2 trends. One, you're seeing a lot more newer people adopting entry into capital markets. That's one. And the preferred route has typically been mutual funds. Of course, a lot of them come into the direct equity route, through the direct equity route too. The second is that the ones who've come are committing serious monies. Now, how do we see that? You see that from an inflow perspective. You've seen that SIP inflows have crossed 19,000 crore. These are public numbers. You see them every month. For CAMS service funds, this number is just shy of 11,000 crore a month. The industry has crossed 50 lakh new SIP registrations. CAMS has crossed 30. This number used to be about half of this number 2 years back. And if I go back 4 years, it was about a third. So you can see that in terms of gross adoption, that's a great metric. Also because there is an ease of entry, there is an ease of doing business. Internet packs are available for 100 rupees. Smartphones have penetrated to multiple tens of crores of people. it's very easy for people to monitor their portfolios, enter, exit, get the capital gains tax, and just a variety of ancillary things are available in such a seamless manner, like they are in the world of digital anywhere else in the world. I think all of that has come together to propel this market. And of course, I think one big reason and underpinning is also that the markets have been significantly up in the last 5 years. I think when you collectively read all of this, you get to the state we are in right now.
Anuj, Kumar, good morning. This is Tamanna here. And, obviously, we're not going to talk about your last quarter numbers because that's not something you want to focus on. But I was just wondering, when you're looking at these massive increases in number of folios, SIP numbers, etc., can you break it down to us and explain what the unit economics is? For a CAMS, what does it mean when, for every, say, 1 lakh rupees invested or 1 lakh new folios opened? Can you break that down for us?
No, sure. So typically when we're talking of these 50 lakh new SIPs coming in, the unit size has been actually reducing, which is a good thing for the market, which means the market is embracing people with smaller savings, smaller investments to make. So this number used to be in the range of 3,000 rupees at one time, is under 2,000 rupees right now. From a unit economics to a business perspective, think of it this way, that we're on a significantly automated business. Our SIP book is, let's say, 5 crore unique SIPs, augmenting or growing at the rate of about 15 to 20 lakh a month. So at that rate of growth, it is important for us to make large investments in infrastructure and IT so that we can process all of this. But our efficiencies also enable us to sell this extremely cheap and economically in the market, create very, very ironclad outcomes in terms of security, management of any potential fraud, keeping complaints low and keeping investors at high. And when you put all of this, you see that from a profit perspective, we continue to be a company with a 44-45% EBITDA, growing at the rate of about 1% a year, 1 to 1.5%. But from the consumer perspective, you see that he is buying it successively cheap every year. And when you put all of this together, a strong fund management regime, people able to buy, fund managers able to buy our services at progressively lower prices, and we are able to run all of this efficiently from an ironclad, delivery perspective, successively every year.
Anuj, that is fantastic. Those margins look really good. Is there an upside risk to that? Is it there's an increase in digitization, adoption of tech, adoption of AI? While it gets easier for the consumer to buy, I'm guessing economies of scale will only help you improve margins, and any upside risk in the near term on that front?
No, so we believe that the 1% up in EBITDA margins, 1 to 1.5% annually, should be on the table for us, which means we should be able to do that. From a tech perspective, we are a very evolved technology shop. When you see complex algorithms to solve problems, deployment of AI, ML, all of that is on the base. So today, if you see things like name matching, face matching, things like redaction of complex strings like Aadhaar, doing payments and settlements on the fly for several million transactions overnight, doing KYC in 10 minutes, pulling investor details through account aggregator and doing matching and setup of accounts within minutes. All of that is already in the base. So all of that has been deployed. And I estimate one of the reasons for the efficiency is that we were early adopters. And the results you're seeing are because we created that as the fundamental bedrock of building our business.
Anuj, I believe the next big bump up in terms of top line will come from the non-mutual fund business. Help me understand what is the contribution of the non-MF business to your top line, and break it down between the AIF, CAMSPay and Think 360. I do know that the affluent investor now is getting more intrigued by the PMS and AIF offering, and adoption and launches of that is clearly going to impact your top line. Internally, what are the sort of numbers you guys are talking about in terms of contribution to the top line and growth on the non-MF side?
So think of it this way, that non-MF is a 13% revenue contributor as of now. We are expecting it to gain by 2% every year. So 3 years from now, it should be in the range of 20%. The three that you named, AIF is just north of 3% of revenue contribution. Payments is about 3%, and Think is about 2 to 2.5%. So between them, they make up about half, or a little more than half of non-MF. I think on an aggregate perspective, all these three markets are seeing a lot of sustained demand trend. AIFs, just from number of AIFs getting registered, in FY22, there were upwards of 250 new AIFs which applied for registration and got it. Similarly, on the payment side, the service rides on the large number of SIPs which are getting registered for our service funds. We're also diversifying into other areas like collecting, monthly maintenance from apartment owners, school fees and recurring fees and those kind of things. But think of 50% of revenue contribution payments coming from mutual funds. And then Think 360 is largely doing business, one on the video KYC and KYC side. That's not so much in the capital markets, mostly with banks. And then they have products like Algo 360 and Business Insights, etc., which are sold both domestically and to overseas consumers. So these are three large contributors to non-MF. We're expecting the non-MF portfolio to scale by about 20% plus every year. We're expecting MF to grow by about 14 to 15%. So blended north of 15% growth in earnings is what we generally state as our mission and what analysts and the rest of the investing populace should believe we should be able to deliver.
So just to clarify, non-MF is going to turn more profitable in terms of margins compared to MF or at par?
Yeah, its first aim is to get to be at par. Today, non-MF is much shorter in margin capability than MF. I think the first stop in about 3 years will be that we get to the MF level as the investment cycle kind of matures. And then, of course, further scaling up, as you know, in a platform business, more revenue generally goes to the bottom line. So we will continue seeing that impact over the coming years.
Right. Mr. Kumar, one quick, try and squeeze in two actually, but I'll start with one. You want to tell us the update with what's happening in GIFT City right now? What is your role? What does that mean for business? Financially, how revenue accretive is this going to be in terms of inflows?
So you see, GIFT City has got a lot of interest in the last about 1 to 1.5 years. There are multiple reasons working there. One of the big reasons, of course, is that for foreign entities or even Indian entities with foreign arms who wanted to do business in India, they would set up the administrative and the fund entity overseas, let's say in Mauritius or Singapore. Today, the biggest reason for someone to come to GIFT is that you can do business in this country and have your setup inside the country. So you get the proximity. Earlier, you were cleaving it into two. Now you don't have to create that cleft. You are in the market. The second thing is that from a tax perspective, I think there's just a lot of benefits in terms of how people can land up here and kind of mirror the facilities or mirror the capabilities they had in markets like Mauritius, which is propelling some of the funds to either set up in GIFT or redomicile. There are multiple services. They're not just AIFs or listing of startups and those kind of things. But you're seeing foreign universities, you're seeing jewelers, ship leasing, aircraft leasing, those kind of things, insurance happening in GIFT City. We believe that that momentum is there for keeps. Multiple segments will continue scaling there. We are largely a service provider for the capital markets, but we are closely examining what else we can do in GIFT City. So therefore,